Hey everybody, thanks for tuning in. This is Eric Dubbelde and Corey Wiederhoeft, both GPPS grain market advisors with CFS. Corey's out of our St. James location and I am out of our Hayfield location. Just wanted to put this presentation together for you all to tune in a little bit and see what has been going on and what is going on in the corn and soybean complexes. And so this is kind of a three-part segment. We're going to first dive into the corn, then we're going to dive into soybeans, and we're going to round it off part three with making sense of it all and why we put this presentation together and what it means. So after this next slide, we'll dive right in. This is just a disclaimer statement for compliance purposes, as some sources and charts came from CHS hedging and MLH futures. So just a quick blurb here for compliance purposes. If you want to read these, go ahead, hit pause and read through them. But most likely nobody's actually going to read these entirely, so we will just move on. Let's dive in. Part one, the corn complex. So here's just a snapshot of the USDA balance sheet from the April WASDE report. Stocks to use is still up around 15%, which is kind of the new norm. Ethanol usage was dropped in April. As we all know, with the coronavirus pandemic, a lot of ethanol plants are idle, which we'll get to here in later slides, but that's the reasoning for that usage being dropped, as were exports. That was kind of a surprise, but given the pandemic and people scared to travel, boats going to different countries and potentially bringing the virus back, there was some ports that were closed and different things, so exports were dropped as well. Corn acres. At the end of March, we had our planting intentions report, and the number that came out was 97 million acres to be planted to corn this spring. Now, that's data as of March 1, well before the ethanol downturn. So the big question out there is, did many and how many acres switch to beans? Which we don't know right now, but we will probably in the coming reports. Now, ladies and gentlemen, that number is what we're basing our current recommendations on and kind of what we're trading, other than just a global virus pandemic. Even if we trim up acres and plant more beans in spots, we'll still have a 93 to 94 million acre corn crop. Now that's probably haven't had that big of a crop since 2016, 2017. And during that year, July futures levels plunged into the 340s. Now let's bring it back and fast forward to this year, pair that 94 million, potential 94 million acre corn crop or higher, pair that with the ethanol downturn and the global and domestic demand downturn that we're currently experiencing. And we have a recipe for very low prices, and those very low prices to stick around. But I'll kind of get to those slides here in a minute. This is just a chart MLH futures brought to our attention, showing the stocks to use ratio after the April WASDE report. Currently, we're sitting at 15.1% of the corn crop nationwide not being used. How this ratio is figured is the current carryout divided by the total demand. So 15.1% of the corn crop in the US is not being used. If you look back over the last 4 to 5 crop years, this has kind of become the new norm, right around that 14.5 to 15.6, 15.7%. Back in 2006 through about 2014, it was kind of a pretty steady trend up and down, but overall, this north of 14% seems to be the new norm. So my question, I guess, is what is it going to take to use more of our nation's corn supply, especially after what we're currently experiencing with the coronavirus pandemic, ethanol plants being idle, exports not being all that great, and ethanol and gas consumption being super low. So on a global scale and domestic scale, the corn complex has kind of completely done a 360-degree backflip since February. If someone were to come to me in January, February and say, hey, I think soybeans are going to have more upside potential and be the leader more so than corn on a global and domestic supply and demand scale, I probably would have laughed. I mean, I really would have. There's nothing pointing to that. Obviously, hindsight being 2020, but there was nothing pointing to that. Fast forward to the middle of March when it did happen, and that's currently where we're at. Corn on a global and domestic scale has totally done a 360, and beans, as we'll get to, kind of is the leader with global and domestic demand. So like I said, ethanol plants being idle is a big deal. And as you can see by this chart, ethanol production was running wide open until mid-March when majority of US ethanol plants went idle. Now, the virus was a big deal for plants going idle, but at the same time margins were in the red, as you'll see on the next slide. They also couldn't get rail cars in to get some of the ethanol out, so they had a supply issue. And then stay-at-home orders were coming in place, which meant people weren't driving. Therefore, ethanol and gas were not being consumed, and all these oil and ethanol stocks were climbing. Long-term thinking, as we've heard from a few plants, that with lower corn prices, margins have kind of come back and they're at least breaking even or even slightly in the black. However, they can't just come back on board and start producing like they did if we don't get any sort of consumption. If we don't get any consumption, then they're just producing and compound the issue with adding to our stocks problem. So I think we kind of need a combination. Margins come back, but we also need to get consumption back on track as well. Like I said, ethanol margins at the time the plants were going idle, most plants on average were losing between 30 and 35 cents per gallon, which was not a sustainable number at all. Switching gears a little bit, we kind of looked at the national scale. Let's look at the global side of the demand equation. As it sits right now, the US through July has the cheapest corn prices. The only one that's even close to us is Argentina, as they dip down to $160 per metric ton in June and $154 per metric ton in July. Otherwise, through July, the United States is the cheapest corn in the world. Now, I don't mean to sound doom and gloom, but the cliche saying, cheap prices cure cheap prices, could be in play. Can these cheap prices drum up some demand from our other trade partners? I think it can. I think we're kind of starting to see that turn in the right direction, as there's been a lot of different players: Indonesia, Mexico, China, Japan, Egypt, all buying U.S. corn from us. And I believe it was a week ago last Friday, this headline came across our DTN news wires. It was a corn and bean sale, but I'm going to read you the corn side of it. Export sales of 589,395 metric tons of corn for delivery to Mexico. Of that total, 369,600 metric tons is for delivery during the 1920 marketing year, and 219,795 metric tons is for delivery during the 2020-2021 marketing year. So we're starting to see it already, that global demand is picking up. We just need it to pick up even more, and we need the fuel market to rebound to get consumption back up there to kind of provide some form of normalcy. This chart is another one that MLH put together showing the corn sales thus far during the year. It's really just a graphical representation showing that as of late, we're still not where we were back in 2018 and previous, but we have spiked upwards and made some positive ground. And if we can keep that momentum going forward, I think the landscape would change drastically. So now switching gears again, the global corn stocks to use. It's no different really than the U.S. global corn stocks. We're sitting right now at 26.8%. Again, it's kind of the new norm since 2013-14 to be upwards of 20-25% of the world's corn not being used. You look back at 03-04 through 2003-2012, the average was right around 16% ratio globally. And I think my opinion on this anyway is since 2013, that seems to be when we really started to pile on and drive home the need for precision agronomy tactics, where the genetics really ramped up, the variable rates, the different micro and macronutrients putting into the ground to really hone in and grow a big crop. Now, as a world, what this tells me too is we love to plant corn and we are really good at it, and we're really good at growing a big corn crop. So I guess what I'm trying to point out is the carryouts and surplus, the new norm is they continue to grow. The world is still awash in corn. How does that information on a global, national, and local scale, How does that affect your corn marketing plans? How does that affect prices? We can't just look in our own backyards. Now, looking in our own backyards does kind of shape the local market and what we see in basis bids as far as your local ethanol plants and your elevators. But from a futures standpoint and global price scale, we have to look at nationally and globally to get our information and make sound risk management marketing decisions. And that's kind of what, I mean, that's what we're here for as advisors and grain staff here at CFS. We get this information. We're looking at it on a global scale, on a national scale, and at the local level to get you the best basis bids at different locations, at varying locations. That's what we do. So give your advisor a call, pick their brains on market information, global information, and just information that we can give to you to try to help you make some of these decisions a little easier and make sound risk management decisions. So now we take a look at the local level, and this is kind of a regional local level as it's across the Midwest or across the Corn Belt as a whole. As you all have seen and known, they're idle, these ethanol plants. So there's been an epic collapse in corn basis driven by that loss in fuel demand and huge surplus in oil. The graph down below shows it. It's the local nearby basis numbers across the Corn Belt. With no outlet other than the river to sell grain, these interior elevators basis bids have significantly widened out unless there's some sort of end user. Ethanol plants are idle, and their bid is either extremely terrible, as if to say we're not posting a bid, or they currently aren't posting a bid. So again, how does that affect our local structure? I mean, it is a local issue, but it still impacts the corn complex on a national and global level. And I'll get to that here on the next slide, but just kind of a little graph here on domestic corn basis across the Corn Belt as a whole. And where you see the big dip, around March 19th, that's where the majority of these plants went idle or throttled back production immensely. So point number 1 and 2 here on this corn basis slide is just kind of what we see and what's going on in our own neck of the woods with these ethanol plants. A couple of the local plants have said that they would like to fire back up in June. They're currently grinding through existing purchases, trying to get through contracts and then take it from there. Valero Welcome is still running, but has been taking corn contracts from 3 other closed Valero plants in Iowa. Other plants have been offloading April-May purchases into shuttle loaders and feed mills. So kind of just a little blurb on what's been going on as far as local ethanol plants. Point number 3 is important because it describes the slide previous. At the current rate of ethanol production, plants would use 3.05 billion bushels of corn on an annual basis compared to 5.425 billion normally. What that means is that 45.673 million bushels are lost in demand every week that these plants are idle. 45.673 million bushels are going back into the carryout. That doesn't bode well for prices or our supply issue. Corn isn't being ground for ethanol. Now, point 4, local feed mills and shuttle loaders are leading basis as well as the river terminals. Corn demand at feed mills is up roughly 20 to 30% with no DDGs available, and if they are available, they are way too expensive, so rations have kind of switched. But really, point 4 lines up why talking to us at CFS is so important. In this time where many different entities in the ag sector are idle, we are not. We're standing tall. We have feed mill locations. We have rail loader locations. We have a wonderful truck fleet where we can put a truck on your farm in order to pick it up and bring it to a river location or a location that's deemed necessary and works for your operation. And we have an awesome flex delivery program to capture delivering to the river if deemed necessary, or a flex delivery program to go to a different elevator or feed mill. A flex delivery program that if you're currently got a contract through us and it's at one of these entities that's idle or not taking grain, we can flex it somewhere else so you can get your grain unloaded and paid for that grain. So really, what I'm trying to say overall is please give your advisor a call, talk to us, we're here for you, and we can make some things happen with different programs that we have. So on this next part, Corey Wiederhoeft, one of our newer advisors, is going to talk to you about what's going on in the soybean complex And then in part 3, I'll come back on and we'll tie it all together and try to make sense of it all.
Thanks, Eric. Here we have a snapshot of the USDA balance sheet from April WASDE report. The stocks to use is at 12%. Our exports, along with our internal crush, have improved slightly from last year, but it appears that a big reason for a decline in the stocks to use was our low level of production in 2019 and 2020. Preventative plant and bad weather really hurt our overall production, but with that said, our carryout is still relatively high for that loss in production. The USDA has us sitting at 83.5 million acres pegged to plant this spring. That's an increase of 10% over last year's planting number, but it is certainly less than the 2018 crop years. This falls more in line with 2014, 15, 16. More of that 83.5 million acres was planted then. So now, I guess the big question is, has there been more acres added to this with the downturn in the corn market? Here is another chart that MLH sent over showing stocks to use. Currently, we're sitting at 11.9% of the bean crop nationwide not being used. Remember, this is with the bean production being down 10% from where the USDA has it pegged for 2020. We had a record high 22.9% in 2018 due to exports to China being slashed over the trade deals at that time. Here's a global scale look at the stocks to use. We are down from last year and have had declines in the past years as well, but the trend appears to be going upward, meaning there's just more beans not being used. Now throw African swine flu and a coronavirus pandemic into the mix, and we end up with less hogs to feed and no place for fat hogs to go. I guess the plus side is that processors still need to crush, and as the next slide will allude to, China still needs beans to crush. Unlike corn, there is a global and domestic demand in the soybean complex. Here is a chart of China's seasonal crush. You'll notice the giant downturn there in mid-January to mid-February. That's kind of when the Chinese New Year is and when they shut everything down. In 2020, it was more so as they were battling the coronavirus pandemic and they were on an absolute lockdown. What this graph represents is the fact that China is still crushing mass amounts of soybeans. With these low prices, the hope is that they will turn to us to spark further demand and whittle further away at our domestic supply. As far as soybean basis goes, soybean meal demand is stronger, with livestock rations switching from DDGs to soy meal, especially in the younger feeder pigs, where DDGs are harder to come by and more spendy at the moment. The average daily rate of crush in March was a record 5.85 million bushels versus the 5.73 million bushels in February. That implies extra demand of almost 3.75 million bushels per month. The meat processing plants' temporary closures may give a small short-term bump in meal demand as the heavier livestock are kept. Maybe not so much in the meal demand as the soy hulls, but nevertheless, it'll still be more soybean demand in general, and it'll help our crush numbers. So the bean basis should remain steady through the old crop marketing year with strong domestic demand, but meager exports. The export market, I believe, is starting to pick up some. Soybean sales were very good, going above 1 million tons for the first time in 20 weeks this week alone as I record this here. So, and China accounted for over 600,000 tons of the total. So it's good news. The market's seen it as friendly. Um, that's it should keep bean basis strong throughout the summer here. So, and just to reiterate on what Eric had said before, we are here to help. We watch this stuff daily. We get these charts. Call us and let's go over your marketing plan. So with that, I'm going to turn this back over to Eric to wrap it up.
Right, so we're back here at part 3, making sense of it all. Kind of taking the information from corn and the information that Corey put together and presented on beans, and tying it together. And I really like this graphical representation here, this little picture. It's kind of a decision tree for sizing up the market, starting with carrying charge and whether or not the futures prices are low or high, and then kind of what to do as far as, okay, got me to this decision. Now I really need to think about an exit plan. So give us a call with that. It's kind of a neat little tree from the Center for Farm Financial Management from the University of Minnesota. This next part, we're going to go through our futures first contract and our recommendations, and really going through some examples and how we as advisors take information from a local, national, global scale on corn and beans and try to help you formulate marketing decisions. So without further ado, let's dive into part 3 and see if we can't make some sense of it all. So what I really want to talk about here is our futures first contract, putting in some open orders to try and capture those prices and really amplify how important our flex delivery is, especially like I said before, in times like these where many ag entities are sitting idle and farmers aren't able to deliver their grain and get paid. So let's first talk about our futures first contract. As you've all seen this before, futures first or HTA, you're setting the futures variable of a cash contract while leaving basis open. The sole job of this contract is set the decent futures price, see if basis improves, set it, get your cash, walk away. Or use it as a storage hedge for those of you who have bins phase. Set the futures variable, see what the carry does to the deferred months, capture that carry, roll to that month, see what basis does, set, walk away. You can contract up to 3 years out. So as it sits right now, you can contract out to 2022. And as you already know, in today's market, the futures price is the most volatile aspect of contracting. Like I said before, it allows you to take advantage of seasonal price trends by marketing grain pre-harvest. The big thing with any of our contracts is the freedom for your delivery location. You can set basis to any approved end user as long as they are in good credit standing with CFS. So what I mean by that, as a CFS grain marketing advisor, if I hold your hedge, you are not obligated and stuck delivering to a CFS location. Now, if a CFS location works for you and has the bid you want, it's in close proximity, by all means, deliver there. But what I mean by it is if you want to flex deliver or deliver to a river terminal, ethanol plant, another elevator, a feed mill, etc., you can. We can make that happen. Or as we're seeing now, when these ag entities are idle or not taking grain or have a bid, there are other options that we can go through with you in order to get your grain delivered and paid. Now, some of our recommendations might be above where the current market is trading. So how do we capture that? Well, what we do is we put in open orders. You know, right now, if you want it, we're not at 350 December futures, but 350 is an attainable number. So if you wanted to put an open offer for a futures contract at 350, we just put in an open offer, and that offer is good until it either is hit and executed, until you call and cancel it, or until it expires because the market never got back up to it. I think that is extremely important in putting these realistic open offers in, because you are not, just like in baseball, you can't win the game if you're not on the field. Base hits is what it's going to take in being a little creative in these marketing times. So I think putting in these realistic open offers to attain some realistic futures prices is needed. And I think we have a great platform to be able to do that. We just call us up, or in talks with your grain advisor, we just put that open offer with our broker and continue to be in talks with you and maintain it, see where it's at, and go from there. So I want to run a scenario by you, a very real scenario. And that is, one of our recommendations says to put an open offer at 350. So the futures price on December 20 corn being 350, contract fee of 3 cents, 50 under October delivery harvest basis. Now this is example only, but we're not far away. December to July market carry is 30 cents. July basis is 50 under for June delivery, and a roll fee of 2 cents. So that's the parameters of this futures first example, and how we can use this contract this year to capture carry in a better price. Scenario number one would be just to plainly lock up the basis part of the equation and set your cash price at $2.97 for October delivery after fee. $2.97 is sub $3, but it's better than where we currently are. Scenario number two is more so for those of you who have bin space and are going to use this as a storage hedge, which is probably majority of what people do with this type of contract. Use your bin space, roll the corn ahead to capture that 30-cent carry to July, lock in the new and improved cash price. Your new cash price then is $3.27 after the 5 cents of fees taken out. Now, not exactly ideal, but it sure beats just forward cash contracting at $2.99. So using, as you all know, if the only way, in my opinion, this is just my opinion, the only way for you to capture full carry in the market is if you have a hedge in place. If you don't have a hedge, you are at the mercy of whatever the end user's bid is. And most of the time, the end user is going to take some of that carry out of the market. So if you truly want to capture all 30 cents of full carry, less a 2-cent roll fee, you need to have a hedge in place in order to be able to do that. And this is a very realistic example. It could happen. Where it gets a little different, I guess, is kind of like we talked about in the first slide. If basis does improve, then you got a decision to make. Do you want to lock that up for harvest delivery, be done, deliver it as overrun or what have you? Or once you roll it out there, the hope is that instead of 50 under for June delivery, maybe it comes into 45 or 40 or 35 or whatever the number is. There's basis appreciation, and you can add that many more cents onto your cash price. That's the hope. Now, it doesn't always happen like that, but this is a contract that is very flexible in how you can utilize it for different aspects of what the market gives you. So this last slide that I'm going to go over with you guys is our current recommendations. And like I said, our recommendations are made using sound risk management tactics and the information we have at hand. So before I dive into that, I'm going to go through, our first new crop 2020 rec was last May, and to get 10% sold at 410 Dece 20 futures, and then another 10 to 15% at 420 Dece 20 futures. So let's just use a producer that's got 40,000 bushels as a production number, just random, 40,000 bushels as a production number. If that person followed our recommendations, they would be just shy of 50% sold at an average futures price of $3.79, with all of the options on the table to roll and flex deliver. Plug that $3.79 number into the slide previous, and it looks pretty darn good. Now, if you haven't taken us up on our recommendations, we have a little catch up to do, but we are still recommending these levels because our bias is that there could be more downward pressure to put on this thing. Nobody that I know of, and maybe you have, but nobody's ever traded a pandemic like this with the current trading systems that we do have. So plug current levels into the scenario previous, and it will look a lot better selling $3.25 cash in July rather than $2.99 cash. Now, we know full well these aren't good levels, but risk has to be managed. You as producers, your risk on this corn crop is if the price continues to fall. Now, I hope that doesn't happen, but if it does, we need to manage that risk effectively. By no means am I saying we as advisors are all-knowing or knew this was going to happen or have all the answers. But our track record as a team has been solid in getting farmers a good average futures price for the marketing conditions and using what the market has to offer to obtain a better than average cash price. That track record is solid. And you can see it in our recommendations from the market plans, and you can see it in the number of producers who utilize our contracts and our recommendations that are better than the average that obtain a better than average cash price overall. So kind of getting back to our current recommendations, right now on old crop corn price basis contracts and continue making cash sales for remaining old crop corn and beans. On the new crop 2020, if you have nothing sold for new crop right now, you're sitting open, sell 25% at current December futures levels and put in an open order for 25% more at 350 December futures. If you have been following our recommendations, or if you have some December futures positions on already, put in an open order with us at $3.50 for December, with the idea of being 50% sold cumulatively if and when that is executed. Now on beans, we recommend being 60% sold at current November futures level. With the way things seem to be headed, carry in the market should be favorable. One thing I missed talking about on the futures first recommendation is with corn, it's a very real scenario that we could see a big crop, big acres number, big crop grown. With the current demand structure, it looks like we could still be awash in corn. Therefore, I could make a very good case and very realistic case that we could see carries to July at 30 cents plus. Last year we had a shorter crop and we saw 28 to 30 cents. So I think it's a very real scenario we could see 30 cents plus in carry charge from December to July. On beans, with the way things seem to be headed, carrying the market should be favorable as well. Planting 10% more beans year over year. We saw 45 to 50 cent carries to the July. So you throw in 50 cents, you can make a case and really enhance your futures level on beans as well. Now on 2021 crop, we're only making a corn recommendation. Get 10 to 15% sold at current levels. With the way things are heading, that's a great place to be. We're a ways out, so we got time, but it doesn't hurt to get something on and hoping it's the worst sale. On beans for 2021 crop, we are not making a recommendation at this time. So for those of you that have tuned in, I appreciate taking the time to tune in with us and watch and go through this. If you have any questions, by all means, give your market advisor a call, give myself a call, shoot us a text, shoot us an email. Let's go through this stuff and really use all the information we have as a whole to take some risk off the table and make some of these marketing decisions a little easier for you guys so you aren't riding that risk management roller coaster. I appreciate you taking the time. I thank you for your continued support and patronage, and I hope you all are staying safe and finding yourselves well, and have a great planting season. Thank you.